Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, welcome to The Explainer. Today, we're going to tackle something that, honestly, gives a lot of foreign property sellers in the US a heart attack. It's this huge tax withholding that just seems to come out of nowhere. We're going to break it all down and turn that shock into a solid, clear plan. So let's just cut right to the chase. This is probably the question that brought you here. You're selling your property in the US, everything's going great, and then someone tells you that you might lose 15% of the entire sale price. Not the profit, the whole price, to the government. And you're thinking, wait, what? Is that even possible? And look, this reaction is completely normal. It's not an exaggeration at all. It feels like a punch to the gut. When you first hear it, daylight robbery sounds about right, because it just doesn't seem fair on the surface. So to make this all super clear, let's walk through an example. Let's meet Mr. Hong. He's a foreign investor, made a really smart move, bought a place for $500,000. Now he's selling it for $900,000. That's a fantastic $400,000 profit. But based on that scary rule we just mentioned, this is the amount that gets yanked right out of his $900,000 sale. $135,000. Wow, that is a massive chunk of cash to just see vanish right at the closing table. So what is going on here? Is this really some kind of crazy tax bomb designed to just take your hard-earned money? Let's dig in and find out the truth behind this 15% rule. Okay, so the official name for this whole thing is FIRPTA. It stands for the Foreign Investment in Real Property Tax Act, and as the name suggests, it's a special law that's aimed specifically at people like Mr. Hong, non-US residents who are selling property in the States. And this is the million-dollar question, right? Why on earth would a law like this even exist? It just feels so aggressive. Well, there's actually a very specific reason for it. From the government's point of view, it's pretty simple. They're trying to stop a take-the-money-and-run situation. See, if you live in the US, the IRS has plenty of ways to make sure you pay your taxes. But if you're a foreign seller, once that money from the sale leaves the country, it's incredibly difficult for them to collect the tax you owe on your profit. So they just grab it up front. Okay, this next part is maybe the most important thing you need to grasp. This is the misunderstanding that causes all the panic. It's all about understanding the difference between a tax and a withholding. They are not the same thing. All right, listen up, because this is crucial. That 15%, it is not your final tax bill. It's a withholding. Think of it like a security deposit or a prepayment towards your future tax bill. It's a temporary hold. Your final tax is what you actually owe, and that's calculated based on your profit, not the sale price. You know what? This is the perfect analogy. It's just like the income tax that gets taken out of your paycheck every couple of weeks. You don't just lose that money forever, right? Of course not. At the end of the year, you file your taxes, figure out what you really owed, and you either get a refund or pay a little more. FIRPTA works exactly the same way. Okay, so if it's just a temporary hold, a security deposit, the big question is, how do you settle up and get your money back? The money you overpaid. Well, it's a pretty standard process, really. Here's how it works. First, at the closing, the buyer holds back that 15%. Then, next year, you file a special tax return for non-residents. On that form, you show them your actual profit, so for Mr. Hong, that's $400,000, and you calculate the real tax. After the IRS processes it, they mail you a check for the difference. So let's put some real numbers to this for our guy, Mr. Hong. Remember, the government held on to $135,000 of his money. But his actual tax on that $400,000 profit, let's say it comes out to around $80,000. So what happens? The IRS cuts him a check for the difference. $55,000 right back in his pocket. Suddenly that panic is gone, right? Now, getting a big check from the IRS is nice, but waiting maybe a year for $55,000 of your own money? That's not great for your cash flow, is it? So the big question is, can you do something about this up front? Can you avoid having so much taken in the first place? And the answer is absolutely yes. Yep, you're not just stuck with this. You don't have to just sit back and take it. There are 3 powerful, totally legal ways you can shrink that withholding amount, or maybe even get rid of it completely before you even sell. Okay, tip number 1, a full exemption. This one's pretty straightforward. If your sale price is $300,000 or less and the person buying it signs a piece of paper saying they're actually going to live there as their main home, boom, the 15% withholding requirement just disappears. Zero is withheld. It's that simple. All right, tip number 2 is for those properties in the middle range. If the sale price is somewhere between $300,000 and $1 million, and again, this is key, the buyer is an individual who's going to use it as their primary home, then that 15% withholding gets knocked down to 10%. That alone can save you a ton of cash up front. And now for tip number 3. This one is the real game changer, the most flexible and powerful option. It's called a withholding certificate. Basically, you get ahead of the whole process. Before you close the sale, you file a form with the IRS and you show them your math. You say, look, here's my purchase price, here's my sales price, my actual tax will be way less than 15%. And you ask for permission to withhold that smaller, more accurate amount. So let's just bring it all home. That scary 15% tax bomb, it's not a bomb at all. It's not a final bill. It's just a process. And the best part is, it's a process that you can actually manage and control. You have options. So now you know the deal. The next time you or maybe someone you know is selling a property in the US, you're not going to be panicked. You're going to be prepared. You know the rules, you know your options. So the only real question left is, which path are you going to choose to make sure you maximize your returns?